We're honored to be joined today by two distinguished leading voices in the regulatory community in the U.S. Later this morning, I'll be sitting down with a fireside chat with Chairman Giancarlo. We're delighted to have Chris here again this year. He has worked incredibly hard, both as a commissioner and chairman, to help ensure the derivatives market is safer and more robust. To those of you who have heard Chris speak know he is a passionate advocate for cross-border harmonization and very focused on technology and the future of banking. So much so, in fact, that Twitter has designated him the handle of #CryptoDad. And I'm sure he'll give his thoughts on this and other updates, in particular Reg 2.0 and CFTC other initiatives. But before that, we have a keynote address from Craig Phillips, Counselor to the U.S. Treasury Secretary. Now, Treasury has also been taking a leading role in publishing some very important and thoughtful papers over the past 12 months as part of its review of the U.S. financial regulation. These reports have defined the scope of the regulatory reform, and I'm really looking forward to hearing Craig's remarks today. So without further delay, please welcome Craig Phillips.
Good. Well, thank you very much for taking the time. It's a pleasure to be here. Scott, when you mentioned there was going to be a movie, I was glad to see that was a cheerful movie. I was down with at another trade in Orlando at a compliance seminar, and Jay Clayton and I were waiting in the back to go on, and they played a movie which was delightfully about every financial crisis that had happened since the beginning of time, the Great Depression, the crash of '87, Ivan Boesky, 9/11, Lehman Brothers, AIG, and so then we came on the stage to do something. So I'm really glad that was a happy movie about collateral. In fact, the cartoon presentation might be, Chris, useful to us explaining certain things to people around Washington, because this topic is incredibly complicated. And while my remarks might be a little less intellectual than the chairman of ISDA that just preceded me, I'll try to be very direct about what our ideas are, what they mean, and how we got to where we are. But I first of all want to thank you for being here. We recognize that derivatives and all their users play an extremely important role in the financial system and the economy, and when used properly, they truly transfer risk and manage risk as opposed to create risk and allow the growth of jobs and stable prices for American consumers. So first of all, we endorse everything that you do as part of the market and the market economy, and it's critically that we get this right. During this conference, you're obviously going to hear further from the CFTC, in particular the chair, Giancarlo, and they've been an excellent partner to us in evaluating the current problems and potential solutions concerning derivative regulation. We have a complicated regulatory framework in the U.S. of multiple regulators that overlap in many ways overseeing institutions and markets, and the CFTC leads in terms of coordination, cooperation, and it's been a great relationship for us. But in particular, the white paper the chairman's released today is critically important statement for the next phase of swap reform. And I consider myself a warming up act for that discussion in a moment, and I'll comment a bit more fully, but I want to offer my congratulations to Chris on the important step, and it's obviously very timely for the gathering here over these days. I'm going to cover really three topics today. One is going over where we stand on releasing reports on the core principles the President's designed. These are core principles for the regulation of the financial system in total. Second, I'd like to briefly describe Treasury's concerns with the European proposal regarding supervision and regulation of CCPs, an important development that's on our mind every day. And finally, I'd like to highlight the efforts to manage the risk arising from the use of LIBOR in instruments, as just mentioned, and the development of a transition plan to an alternative reference rate. So first of all, on the core principles, the President brilliantly issued in February 2017 a directive, and that directive in an executive order called for the Treasury to identify statutes and regulations that inhibit the regulation of the financial system according to the core principles. And the core principles are really values, things that, as I've reflected on it now more than a year out, are critical to all of us. They're things such as empowering Americans to make independent financial decisions and choices, preventing taxpayer-funded bailouts, fostering economic growth through vibrant markets, enabling our financial service companies to be competitive around the world, advancing American interests in international financial standard-setting bodies, making regulation efficient, effective, and appropriately tailored, and restoring public accountability within the framework. ISDA and many of its members made a tremendous contribution to us in approaching this topic, and we prided ourselves in doing a lot of outreach to academia, the industry, advocacy groups, and the regulators themselves to develop our recommendations. It's now almost a year where we've released our first report covering banks and credit unions. In October, we released 2 reports, one on capital markets, which is the heart of your interest, and then later in the month, asset management insurance. And we're working on a final report concerning non-bank financials and fintech and the very important topic of innovation. And we're going to probe where innovation is, why is it in the regulated system or not in the regulated system, and this is a very key thing to get right, which the CFTC and other regulators have noted. So in our first report on banking, and I'll just comment there before I move to capital markets, we really basically have advocated for just a rebalancing. I wouldn't call it deregulation, but really a rebalancing in light of the significant improvement in strength since the Great Recession. These recommendations, we believe, can better align the banking system to serve consumers and businesses in order to support their economic objectives and drive economic growth. And in fact, through thoughtful reform, the soundness of the financial system can be even further strengthened. What I mean by that is that the combination of some of these rules, if you really study them, could have unintended consequences of limiting liquidity, the flow of capital, and other factors. So exactly what's meant to provide strength could become a weakness in certain market conditions. A lot of our focus was on the interaction of capital and liquidity regimes, and if you just look at our report, you see the tremendous complexity in the nature of these rules, and as they were implemented over a series of years, maybe some unintended design consequences of false complexity and how they interact for a regulated entity. Stress testing regimes and the implementation of gold-plated standards for our largest banks create challenges for their global competitiveness. At the same time, enhanced prudential standards for foreign banking organizations have deterred investment in the U.S. banking systems. Treasury believes actually that the investment of foreign banks in the U.S. banking system is actually a source of strength of the system and also propels our connectivity globally. So really, we want to make our banks competitive at the same time creating a level playing field and encouraging foreign investment in the United States. Show us briefly some of the highlights of our recommendations that really relate to markets and capital and liquidity is first the rationalization of the Volcker rule. The Senate bill has a raising a threshold of banks over under $10 billion not being included. We mentioned several other things of removing unnecessary compliance procedures, eliminating requirements on too wide a range of banks and even parts of banks such as covered funds and normal banking activities. We did not advocate a return to proprietary trading. So we're hopeful that the Federal Reserve will have some new rulemaking shortly on the Volcker rule to put this in motion. And as you know, the Volcker rule has 5 rule writers, so it requires very much interagency coordination. Secondly, there have been significant restrictions on leveraged lending guidelines that have unnecessarily restricted the flow of capital. The OCC has already issued a statement on this. It's really a matter of sort of enforcement and thresholds as much as a policy that needs to change. And the OCC has clarified we think, the right path on this topic as it impacts inordinately large companies in the standard and creates a very aggressive reporting regime if you're involved in leveraged lending, which is a deterrent for banks to offer the product at all. We've advocated for recalibrating the GSIB capital and liquidity buffers. The Federal Reserve recently has put out a rule for comment on a new capital regime, which would be simpler. Some comment on the leverage ratio, and we believe further work will be coming on liquidity. If the Senate bill goes through as planned, and we fully expect it will, we would encourage the Federal Reserve also to revisit the nature of enhanced prudential standard thresholds for foreign banking organizations, something the bill is silent on. The supplemental leverage ratio is very important to get right. I'll comment on that a bit further as it relates to derivatives. And finally, the initial iteration of the fundamental review of the trading book and the net stable funding ratio, both Basel standards, were widely recognized as being miscalibrated. In our report, we argued these standards should not be implemented in the United States until the risk of them and the valuations are reworked. The Basel Committee as a whole agreed in December pushed the implementation timetable back to 2022 to allow for recalibration. We do support their adoption in principle, but they have to be thoughtfully implemented on top of the capital and liquidity regimes that we already have present here in the U.S. So in aggregate, there are many more recommendations. We've been working with the primary regulators and also supporting the legislative process, and we're very encouraged by the progress. There's also, of less relevance to this group, a lot of work on consumer lending initiatives with the CFPB to enhance the flow of credit, enhancement to the Community Reinvestment Act, change in the fiduciary rule, along with many, many other factors that impact the flow of consumer credit. Very important to the economy, but maybe less relevant today. In terms of capital markets and derivatives, I think it's always a joy to talk about the U.S. capital market as we enjoy the largest, deepest, and most vibrant market in the world. So we've done a lot of things right, and every time we talk about fine-tuning, I really like to emphasize that as something we should be very proud of. Also, it's very strategically important to us because the United States derives a larger part of its capital from the capital markets relative to most other systems. So getting that right to preserve the flow of capital decreases pressure on our banking system, but it already works very, very well. So the key is how do we optimize that both on the domestic and global basis. Certain elements of the capital market frameworks are functioning well and have supported efficient markets, and other needs reform, and those are what we focused on in our report. A lot of that reform is for better calibration and tailoring, and also just looking at the practical side of market functioning and market protocols to make sure they're geared right to achieve their stated objective. You can have sort of a great rule and poor implementation. You can have a poor rule and great implementation. So a lot of this is really in the details of what the intent of the either legislation or regulation was and how to properly relook at it. And as so many of these rules were conceived somewhat in haste following the crisis and rightly the global reaction, it's very timely to look back at this with the perspective of time and think about the future and even the shape of the next crisis and how to anticipate what is really critical in the regulatory system. So first of all, there are a few categories that top on. One is equity capital formation, and for companies of all sizes, and that partly that relates to liquidity in the equity market. We're very troubled by the decline in the number of public companies. It's down over 50% in the last 20 years. We think that the burden of being public can be reduced. There's certainly frictions in exploring the process of going public. Companies are staying private longer. Filing requirements, the nature of funding emerging growth companies, better aligning rules for investment and investor criterias are all critical to support new issue offerings. And this includes supporting research services. There's been a huge change in equity market structure. This is translated into issues raising capital on an IPO, and we'd like to address those. Capital is particularly important for small businesses, and small businesses really drive job growth. If you look at the largest companies, they've really had negative job growth over the last 25 years. So all of the growth really has come from mid-sized and small companies. So it's critical, whether it be crowdfunding or other nature of, as I mentioned, accredited investor eligibility and other fundraising methods, that we make capital available for our companies. As I mentioned, a piece of being public is liquidity, and we've created a market structure where the largest companies are probably more liquid than they've ever been, but unfortunately 80% of the companies are probably less liquid. So the SEC has started to focus on this topic, had a working group just this week on studying the nature of market structure, the liquidity in equity markets, and how it can be improved, all exactly aligned with the point that we made in our report. Secondly, Treasury believes that securitization when used responsibly, provides opportunities for investors and a valuable risk management tool for lenders to diversify their concentration. I would sort of put it second to derivatives and complexity. Securitization is a bit simpler, but it all suffers from being lumped together as having something to do with the financial crisis, and therefore sort of a cloud around it in some ways, even to today, about how it should be regulated and how it functions. Like derivatives, securitization is an important financial tool, and we made several recommendations. We believe in general that crisis reforms went too far in discouraging securitization across multiple asset class. This relates to bank capital and liquidity requirement, risk retention and disclosures, and in general is a discrimination between this as an activity. And what I mean by discrimination is if you take a pool of assets in a security versus a comparable pool of loans, generally the capital treatment, liquidity treatment, and other features are much more severe, such that the process of securitization is inhibited right from the beginning on the bank's balance sheet. There obviously have been strong improvements in the quality of credit origination, the accountability of originators, transparency, which are critical to maintain, as well as the vigilance of investors and the rating agencies, all of which have changed substantially since the crisis. Several measures that we've talked about that are worth noting is the capital regime, as I mentioned, relooking at the nature of treatment of securitized exposure versus loan exposures and trying to achieve more equal calibration, appropriate calibration. The second is the disclosure requirements are very robust. Like many of these regulations, there's a phase of sort of additional requirements. We've actually talked to investors, issuers, and almost every stakeholder, and most agree that some of the level of increased disclosure is unnecessary and will be burdensome. There's also issues in delay of issuance from pricing and disclosures that create practical issues at the time of issue. And finally, we recommend a simpler regulatory regime for risk retention. In most asset classes, the market sort of decides a price based on the risk of an asset or an offering. In this product class, a risk retention was mandated in Dodd-Frank as a percentage of the holding. There are exemptions for certain quality of assets. We think there should be uniform exemptions across all asset classes to make sure that the market has access to the credit that they want to invest in. And we think this is warranted in light of the other improvements. It is interesting to note that a court vacated the decision that CLOs were subject to risk retention. That had been rejected in a court. As you know, the court also has now vacated the fiduciary rule and obviously had reversed the designation of MetLife. So as we talk about these changes, it's interesting to note this is not the Trump administration, this is the judicial system independently making decisions about some of these same points we're discussing and reversing regulatory actions. So for us, that kind of gives us a sense that some of these ideas are not far off, that, you know, in the case of the CLOs, it was determined that they weren't loan originators, therefore the statute did not apply, but it was a good wake-up call concerning the accountability of regulation and the appropriate tailoring. Now, in terms of derivatives and clearing, I know Chris is going to talk a lot about this, but in short, you know, the key is to really get this right, and it really relates to almost every aspect of what I just talked about: bank capital, liquidity, trading practices, and market access. And the key is the devil is in the details. So we really found several different areas that, you know, we kind of would highlight, and I'll kind of conclude with some big picture items in the end, and we think the CFT is exactly on the right path. So first of all, just the harmonization of CFTC and SEC rules are really critical. Scott mentioned a few minutes ago, there's no real debate about Title VII reform and some of the key objectives, but finishing the rules, harmonizing them, avoiding unnecessary overlap needs to be a critical objective of those two organizations. Secondly, we're very supportive of central clearing, but not all swaps are cleared, and of course not all cash instruments are cleared. So therefore, it's very important that uncleared swaps are treated appropriately, which may involve recalibrating the required initial margin to be more tailored to the relevant risk. The nature of margin, in particular between affiliates, should be revisited, and the SEC should repropose its rules for uncleared security swaps in a manner that's aligned with the margin rules of the CFTC. Third, required capital just has to be rationalized. The current exposure method has numerous shortcomings for the measurement of capital of derivatives, futures, options. It's relatively risk insensitive, which is counter to the overall capital regime of banks and really tried and true methods. And while the Basel Committee has developed the standardized approach for counterparty credit risk, or SACR, to address these issues, its implementation has been delayed, and it may need to be properly calibrated. We've had extensive discussions with the Federal Reserve and other regulators. I think there's an understanding of this. They've had other things on the agenda. I've noticed sort of not a tension, but just a bit of a disconnect between prudential regulators and market regulators, and then a market regulator wants the products to be sound and markets to function, but looks at it as a product. A prudential regulator looks at it, well, if an institution can never fail, that's my objective, with less concerned about markets. Now, of course, if markets aren't liquid and don't function, it creates a risk to those institutions. So it all comes together. This is an issue that's probably so complex that working together we can get somewhere. but it's taken too long in this stage, and we think it's worthy of revisiting it. The nature of cross-border issues are very important. The CFTC and SEC should continue to work with non-U.S. regulatory authorities to ensure swaps and security-based swaps rules across jurisdictions are compatible to the extent possible. This cross-border cooperation is not easy to achieve, but we believe we can achieve it. And the global approach is something that we just can't lose sight of as we look at our domestic agenda. Now, in terms of clearing, of course, the largest reform in Dodd-Frank was the introduction of mandatory clearing with a significant increase in the percentage of swap cleared. This mandate is generally viewed as having been very successful. At Treasury, we believe it's actually reduced the risks in the system. This is a point of some debate in Washington and along political lines, but we truly believe it has reduced risk. However, central clearing houses are bigger than they've ever been. They continue to expand their products and services and selling data and other elements, as well as continuing to undergoing a substantial increase in size through acquisitions and consolidations, all of which are healthy, but point to the critical factor of how they're regulated. In the US, the FSOC, which is a body the Secretary views as extremely important, designated many of these entities as SIFMUs, or systemically important market utilities, which really put them in a unique category of having access to a Fed account, access to Fed liquidity resources, and an emergency feature, and generally subject to enhanced standards. However, after all of these years, there's still sort of a question of, is the recovery and wind down plan and process finished, and what else do we need to do to make that understood, transparent, and permanent? Risk may come from financial and counterparty risk, and our movie about the collateral shows a bit about that, but the risk might be from cyber. There might be some other kind of operating risk. There might be political risk or other things that sort of are introduced in the system. So the real key to this is having a real vibrant process by which recovery, hopefully, or if necessary, resolution works, and finishing that work. The Treasury has put out a recommendation concerning orderly liquidation authority, which we advocated for retaining that policy with some substantial changes in its operation. And one of the big changes is an enhanced bankruptcy code, a Chapter 14, that would decrease the chance that orderly liquidation authority and the orderly liquidation fund has to be used. I know ISDA has done a lot of good work on the ISDA protocol of allowing for sort of the stay on derivatives. We think a new Chapter 14 that memorialized that for all institutions would be very favorable, because it's not just derivatives, it's any number of liabilities that are subject to liquidation, which is really the run on the bank that accelerates effectively the problem you would probably have inside a CCP. But from doing that work, we really found that although the CCPs are eligible for Title II, Title II has a lot of defects in terms of its practical application for CCPs, which presents a challenge for the regulators as to what tools they have to work with. My second topic, briefly, is on the European CCP proposal. Last year, the EC and the ECB issued proposals that would bolster the EU level of supervision and regulatory authority over both European and non-European CCPs. These proposals, if approved, would give the EU authorities broad powers to categorize or tier a third country CCP based on their view of its systemic importance. This tier would in turn determine applicability of the EU rulebook to the CCP and whether the CCP must relocate to the EU in order to provide services to EU firms. So while this has arisen from Brexit, we are now involved as a third party, and it's critical that the right calibrations achieved. So these motivations, regardless of their source, if adopted, could really affect U.S. clearinghouses in the U.S., since both the U.S. and U.K. are third countries. So accordingly, we have significant concerns with the proposal if it's not properly implemented. The proposal includes unnecessary and redundant recognition requirements that may jeopardize the CFTC EC CCP equivalence agreement that was already arranged and negotiated successfully in 2016. It could increase costs unnecessarily to firms in addition to the clearinghouses, which would reduce the incentive for clearing. And finally, a relocation policy for clearinghouses could fragment global markets and diminish market liquidity. So we're very supportive of international cooperation and standards. We think we have done that consistently. The U.S. Has been the first in finishing many of the reforms called for from the original G20 Accord from Pittsburgh, and we should be proud of that. But we really do want to insist on clarity and criteria in the timeline and finishing of this very important proposal favorably for United States interests. Lastly, on LIBOR, I won't say a lot more than that was mentioned earlier, but it's just critical that the industry really focus on this. I won't highlight the figures and numbers, you know them well. Having joined government a little more than a year ago, there's a bunch of programs I'm involved in. They're in various stages of sunsetting and started years ago. There's things that are starting, there's things in between. And what I'm taken from all of them is people wait too long to actually do the things that they need to do. And this is just too important for industry not to take action. Obviously in the documentation, it's been well documented that the number of actual transactions measured by LIBOR has fallen to a ridiculously low level, and by ridiculous, very small relative to the body of risk that LIBOR applies to. And that is an unacceptable and unsustainable reality. So I guess we participate as an ex officio member of the Alternative Rate Committee. We are very supportive of the issue and the solution, but there's a lot of work to do. The two things I would mention is that this is truly a market-led transition. It's not a regulatory-led transition. And since all the market participants are the ones most effective, it's critical that you coalesce quickly around constructive and workable solutions and try to advance the movement of liquidity into this new space as rapidly as possible. The sooner market participants act, in our opinion, the easier the transition will be. People want to move together in liquidity to maintain a liquidity pool. You can do that by staying in the old space or moving to new space. The more you can move together and as quickly and as efficiently as possible, we think will promote sound markets. The sooner you act, though, the transition will be easier. An estimated 82% of LIBOR exposures will mature or roll off by the end of 2021. So really the real question is how many new exposures do you create in LIBOR and how many have you shifted to the new index? So and finally, I just really want to conclude, before Chairman Giancarlo comes on, to really once again acknowledge the tremendous importance of the new paper that they published today, the Swap Regulation version 2.0. It's spot on in supporting the swap market reforms that were incorporated in Title VII. Treasury strongly supports them. So our remarks about refinement and tailoring, not change or repeal. The importance of CCPs to the economy, the nature of their risk, but the importance of a resolution regime, very important, and a highlight of that paper. Technical things such as swap data reporting is something that was mandated by Dodd-Frank and have been implemented, but there's substantial room for improvement. The general rule set of making markets, trading, and price discovery. And finally, the very important definitions of end users and how investors are treated. Investors and end users of all types, sizes exist in this market, and it's critical that they're properly treated and calibrated relative to the very important dealer community. So first of all, on behalf of Secretary Mnuchin, I want to congratulate Chairman Giancarlo on this important policy statement and look very much forward to hearing from him now, as I'm sure everyone else does. I want to really thank you for your time listening to our proposal, a summary of our proposed regulatory changes. We're proud of them. We think they're meaningful, and we think they can advance the American economy, jobs, and the welfare of all our citizens and institutions. Thank you very much.